On Thursday, the 27th of August, 2026, the oil market is caught between two very different pictures of the Strait of Hormuz. U.S. Energy Secretary Chris Wright says the U.S. Army helped ship more than 15 million barrels in one day last week, with a 7-day average above 8 million barrels per day. Independent tracking data suggests only 2 to 6 million. Mufg's Derek Halpenny notes crude prices have fallen after President Trump declared the strait clear of mines, but he highlights skepticism about that claim. The headline number and the physical reality appear far apart, and that gap is the single most important variable for energy prices right now. Over the past week, several forces have collided. A New York Times report that Washington may return diplomats to the Middle East briefly pushed oil lower, because it implied no full-scale conflict. Part of that drop reversed when the Iran-Oman charging deal was seen as an act of defiance by Tehran. Meanwhile, Iran's Persian Gulf Strait Authority announced stronger transit rules. Kpler recorded 121 crossings in the week of 17 to August 23, only slightly up from 118. Yet 62 crossings were classed as route undetermined. That phrase matters. Shippers themselves are unsure of the legal and security framework. Route uncertainty remains the key feature. Here is why the confusion hurts. U.S. distillate inventories, which include diesel and heating oil, are at their lowest seasonal level on record. Total Gulf exports through Hormuz are estimated at 7 to 8 million barrels per day, double mid-July and about 75% of pre-war levels, but Kpler puts direct crude exports at just 2.2 million. The difference comes from slower, costlier shuttle traffic near Oman, used by Kuwait, Qatar, and Saudi Arabia. Global supply is down more than 5 million barrels per day from pre-war levels, while demand has fallen more than 3 million. The market has tightened even as demand weakened, so any fresh scare can produce an outsized price spike. Looking ahead, Mufg's Halpenny puts it simply, the answer depends on the degree of traffic actually getting through Hormuz, and the current oil price level suggests traffic is higher than previously thought. But if diplomatic gestures do not turn into a durable reopening, or if Iran's new transit rules deter more shippers, expect a sharp bounce. Operation Economic Outcast, Washington's effort to isolate Iran economically, is adding another policy premium. The next move will not be decided by speeches, but by weekly vessel counts and U.S. inventory data. Watch the undetermined route share. If it stays near half of all crossings, the market is pricing more risk than officials admit. The Strait of Hormuz remains the single biggest choke point for global oil, and right now the data is contradictory. Official claims of 8 million barrels a day are not confirmed by independent trackers, while record low fuel stocks leave no cushion. The practical takeaway is clear: follow the physical evidence, tanker movements, inventory reports, and route classifications, not just declarations. Today's market is a battle between diplomacy and actual flow. Until those two align, volatility is the trade.